And
All
one
right.
more thing, if anyone has any questions, please put them in the question and answer, and we will have a few minutes at the end of each session before the break to answer the questions.
All right. Thank you. And so our focus today is going to be discussing the Schedule A, Schedule C, and Schedule D. And of course, we're going to talk about other topics, but that's our focus for today. And if you're new or newer, the Schedule A, those are the itemized deductions, simply a laundry list that Congress has come up with. And so on your tax return, you either take the standard deduction or the itemized deduction, whichever is greater. And then the Schedule C, that's going to be for your sole proprietor, someone who's not in a partnership or an incorporated entity. And we will see a lot of that in the VITA program. And then we'll talk about the Schedule D. That's used for a number of things to include reporting your capital gains and losses. And we'll get into that in detail. And then we have an exercise. It's the WIN exercise. And this is a married couple that's going to file a return. We'll go to noon, and then Robert, if you want me to, I don't have anything until about 4 o'clock today, so I'll happy to extend this. If you want to extend it, you can think about that. This is the laundry list of all of the folks at the St. Killian's VITA program, and the individual on the line right here is Robert Andrews, and I'll give him a little bit of a shout out. Robert Andrews, he's been involved with the church for a couple years. He's also worked with me at Coastline College, and he's a pretty good guy. He's been around the block a few times. He's also a military veteran, and he's one of your go-to guys, in addition to all the folks on the screen here. References are important because we know that the publication 4012 is going to be our go-to document, but sometimes you're going to go ahead and jump into another type of IRS publication or form to look up a particular rule. And one that I highlighted here on the screen, you'll see this at the VITA site. I see this every season. People come in and they have a piece of paper. It could be a settlement for an attorney for a law firm, and they'll say, "Jerry, is this a taxable or a non-taxable item?" And I'll look them in the eyes and say, "I don't know. Never seen that before." And so what we'll do is we'll ask them questions. We'll jump into the publication 525, and if it's in scope, then we'll help them out. So an example would be a settlement from some type of class action lawsuit. And I get this all the time. People say, Jerry, I've got a settlement. I was awarded $5. I was awarded $15,000. And is this taxable? And then, of course, it begs the question, what is it for? And so 525 will answer those questions for you. We already know what the 4012 is, and hopefully, Robert, I think you mentioned last week they're going to start getting those hard copies out to the volunteers. The 4012, whether you are an attorney, a tax attorney, an enrolled agent, or brand new to the program, that is your go-to document. As a VITA volunteer myself, I use the 4012 each and every season. I open it up, I wear it out because it's a very well written, easy to understand publication for VITA volunteers. And so I'd recommend that you really jump into that. That's your go-to document. We already talked about the certification, and for certification, it's brand new for 2025, which means you're going to certify for tax year 2025, and you're going to start off with the volunteer standards of conduct. I checked yesterday. I didn't check this morning, but I checked yesterday, and the 2025 tax year 2025 certifications are not active. And that's not a big deal. It's not a showstopper. But what it is the IRS is eventually going to post 2025, and that's where you're going to start. Once they do post it, we'll go through the mechanics and we'll show you how to actually access the link and learn and start going to the certifications. You start with the volunteer standards of conduct, and then you do the intake and interview. The intake and interview sheet, it's accountants would call it a lead sheet. Very critical document. Taxpayer is going to fill it out. And this is something that you're going to see with certain taxpayers. And this is the way I do it. There are people who do not have the ability to complete the intake and interview form because they don't understand certain things. It could be a language thing, it could be a cognitive thing. And so what we do is we ask them questions and we help them fill that out. And that's okay. It does take a little extra time, but at the end of the day, we want to help everybody we can. And then once you complete the intake and interview, as I mentioned before, you can certify at the basic level after intake and interview. I highly recommend that you certify at the basic level and then graduate to the advanced level. And if you do that, you're going to be well prepared for the VITA program for this coming season. The 1040, there are a number of things, and we're going to talk about some of these today. The instructions to the 1040 are also a very valuable document. They're going to give you tax tables, although you really don't need tax tables. But I've been asked before, hey, Jerry, how does the software calculate the tax? I said, well, it's easy. They use the tax tables, and they go, where are the tax tables? Well, you can't press a button in the software and look at them, but I can show you on the instructions how tax is calculated for taxable income. And so that's a useful document. And then we introduced you last week to the Schedule Alpha-1. That is brand new, and it's not a complicated document, but it's for additional deductions, and that includes your tips, your overtime, your car loan interest, and what is called your senior deduction. So you'll see that most likely on a lot of returns, the Schedule A-1. And then at the bottom of the screen, this is typically what you're going to see when individuals have a personal residence and they're trying to deduct the interest. That we issued a 1098 mortgage interest statement, and that's generally what you see. And you're going to hear me say generally or the general rule. That means most of the time. And there are exceptions, but generally you're going to see the 1098 when people have a mortgage. So, for example, I got a mortgage, and my mortgage company sends me a 1098 every year, and it shows the interest that I pay. And then, of course, if I have an impound, that means they're collecting, they being the mortgage company, if they're collecting the property tax to remit to the Orange County property tax assessor, that's also reflected on the 1098. Other documents, there's a lot of emails going back and forth regarding the publication 6744. Actually, it's a form 6744, and that's a volunteer assisters test. This is my recommendation when the dust settles and you're ready to certify. I highly recommend that you use the 6744. You're going to read the question, you'll answer the question in the 6744. And then when you take that certification, it's a matter of entering data into the program and hitting submit. I do that. I think it's very useful. And even though, as I mentioned before, I do have a little bit of experience with taxation, I still use the 6744 and I look up all of my answers. I mean, obviously, I want to pass the test, but it's good to look at the answer to get that knowledge. And then we're going to talk a little bit more about the 13614C. That's the intake and interview sheet, your lead sheet. It comes in different languages. And so, for example, at my VITA site at Coastline College last year, we have a lot of customers who are Vietnamese speaking and Spanish speaking. And so we have worksheets or intake and interview sheets for those individuals. And as I mentioned before, if you make the site comfortable, you build a rapport with the clients. It's like in any business. People are happy, they feel comfortable, and they're going to go back. And that's why the IRS has a number of intake and interview sheets in many different languages. And then once we're ready to talk about certification, when the IRS does post that, we will get into 13615. That is your contract with the basically with the site coordinator slash IRS. And so that particular document is going to have your administrative data on it, along with your certifications. And so I've gone to sites, I will call the site coordinator and they say, come on over, Jerry, we'll put you to work. I show up with my 13615, which is completed with all my certifications. I have my government ID. I show it to them, and then they put me to work. Franchise Tax Board, later on in these sessions, these Zoom sessions, we do get into the Form 540, which is the California tax return in great detail. Here's a couple things that you want to be aware of right now. You're going to have people who will sell their personal residence, and a lot of times we can help them in the VITA program. Typically, it's going to be your more experienced preparers. And one of your go-to documents you're going to ask for is the 593, which is the real estate withholding statement. When you do sell your personal residence, generally there's going to be withholding. That withholding is 3.33%, and that'll be reflected on the 593. And then, of course, you might be familiar with this because I'm going to guess everybody on the call is a California resident. The general rule in California, if you're a California resident, you have to have some type of health coverage, and you can get it many different ways. You can buy it from an insurance company. You can get it at work. If you're a veteran, generally you can get it. You can get it through Medi-Cal, Medicaid, Medicare, or you can get it through Covered California. Different ways to do it. And there is a form for an exemption. There are exemptions. So, for example, if you have someone who's so low income that they cannot afford health insurance, and for some reason they can't get it through Medi-Cal or Medicaid, then they're going to be entitled to an exemption. There's many different types of exemptions, but the general rule is you have to have coverage. And most people who come to our VITA site, they're going to have, if they can't afford insurance, they're going to have it through Medi-Cal or maybe even Medicaid, something like that. I don't get too geeky when it comes to the Internal Revenue Code because in the VITA program, usually you don't see that citation, but that's the federal tax law. And when you hear the term tax law or the body of tax law, that includes the Internal Revenue Code. It includes federal court cases, tax treaties, Treasury rulings, um, I should say regulations, a number of things. But you may hear me from time to time you invoke the Internal Revenue Code. And just a couple things here. I get this at the VITA site all the time. People come to me and say, I've got this item, and is this item considered taxable? And so a lot of times I know it off the top of my head, and they'll say, oh, yeah, W-2 wages, the general rule is it's going to be taxable. That's Section 61. Sometimes people say, Jerry, I got this. What is it? So we'll ask the question, we'll have the conversation. I'll say, you know something? I've never seen that before. And so then I revert to Section 61, which means everything's included in gross income unless otherwise excluded. And so what we do is we try to determine if that item that they show me is excluded. If it is, generally it's not recorded on a tax return. We talked about the sale of a residence. We're going to get into that. There's an exclusion. This is a great thing for taxpayers. They can exclude, if they're married, up to $500,000 for the sale of their personal residence. And so that's a good thing for the taxpayer. It's not good for the Treasury, but it's good for the taxpayer. And you'll see that from a lot of times when you have someone at the site who sold their house. And then you can hear me talk about capital assets today. When you hear the term capital asset, those are items typically like stock, bonds. Your personal residence is a capital asset. If you're wearing shoes right now and you own those shoes, those are capital assets. So we'll talk about what is called the sale or the disposition of a capital asset and calculating gain or loss. Again, when the Lincoln Learn comes online for certification, you're going to be able to jump into that and certify. It is not online. Well, as of last night, it's not online. The 2025 tax return is online. It's a work in progress, and it does not show any states right now. All right, so let's go ahead and get into our income items. So at the VITA site, you're going to see a lot of individuals who are on Social Security. And so in the publication 4012 on page D57, it discusses Social Security. Usually it's a pretty easy thing. You'll ask for that SSA 1099, which is a document that the taxpayer receives, and then you'll enter that data. And we're going to show you how to do that. You're going to enter that data in the software. And that's generally what you're going to do. And then usually on the SSA 1099, you'll also have the Medicare premiums that someone pays. And that's the general rule. There are exceptions. And the last time I looked, there's no statutory requirement for anyone to sign up for Medicare. If you want to sign up, you can sign up, and of course, you're going to pay premiums. And then this is something you'll see every once in a while. I saw this a few times at a couple of VITA sites where someone receives Social Security in arrears. So, for example, they apply for Social Security, they don't get it for a couple of years, and then eventually they get a big check, which pays for maybe tax year 2025, tax year 2024, maybe even tax year 2023. That's called a lump sum payment. And there's certain ways to handle those lump sum payments. So my recommendation is if you have one of those, you'll see that language on the SSA 1099. You probably want to make sure you have a senior preparer with you, and then you can jump into the publication 915 and you can go ahead and determine what you need to enter in the software for a lump sum payment. And you see that once in a while. Retirement income, this is something you'll see again and again. 1099-R, it's for retirement. It's also for, let's say you cash out your 401k, and you'll see this, individuals in their 30s and 40s, they, for whatever reason, they cash out their 401k, they get the money, and they figure they've paid the tax. And well, that's not the entire story. What they've done is they've paid usually most of the tax. And then the reconciliation is the filing of the return. And if they're under 59 and a half and subject to that 10% federal penalty, they're going to pay that on their tax return. So that's usually an emotional event for younger individuals in their 30s and 40s who've taken a distribution from their 401k and they think they've paid all the tax. And that's not the case. This is something, if you're making mental or written notes, you want to jot this down. We will discuss this in a session. It's called the Simplified Method Worksheet. And I'll use me as an example. So I retired from the IRS a few years ago. When I worked as an employee, I made contributions to my pension. That means I have what is called basis or cost in my pension. And then as I receive my pension check every month, I recover a portion of that cost. What that means is all of my pension is not taxable. A lot of it is, but not all of it. And so if you have that, when someone says, yes, I have costs in my pension, that means you're going to use the simplified method worksheet. And then that way you're going to be able to determine the total amount that's taxable for the individual. Because you're going to see on the 1099-R, you're going to see amount that it'll say undetermined. And of course, that's kind of scary because in the tax world, you want to determine everything. And so when you see something undetermined on the 1099-R, you'll be able to determine that by asking a few questions of your taxpayer and utilizing the simplified method worksheet. Qualified charitable distributions. I remember the first time, I think it was like 5, 6 years ago, I was teaching a class and someone asked me the question about this and thinking, don't worry about that. And the guy was a tax preparer and he walked out. He was disgusted. And I thought, well, I better read up on this. Well, I have, and I've given presentations. Qualified charitable distributions, it's not just for someone who's very wealthy. We had someone at St. Killian's, I think this was 2 years ago that I helped out with, and she was a very generous woman, and she had a retirement plan. And then what she did is she had her distribution go directly from her retirement plan to a qualified charitable organization. And what that meant is she's not going to be taxed on the distribution. Of course, she couldn't take what is called a charitable deduction on her Schedule A. But you might see qualified charitable distributions, and if you do, there are certain rules that have to be followed, and you'll see those on page Delta 69. And that's a non-taxable distribution, which is a good thing for the taxpayer. They're helping a charity out, and they're not being taxed on it. Other income, and again, there's different terms to describe this. One term is other income, ankle biter. Someone comes in with a 50 or $100 item. I had someone come in with a $160 item. I'm thinking, well, we have to treat it correctly. And so what you're going to do, you're going to utilize your publication 4012. And if you can't find the answer there, and if it's in scope, you'll probably find the answer in publication 525. So this is something you'll see from time to time, cancellation of debt. And a lot of people, when this happens, their head kind of spins and go, what are you talking about? So here's an example. Let's say you have someone gets a credit card and then they go ahead and make charges, goods and services. Let's say they rack it up to 25,000, and then they either are unable or unwilling to pay the debt. And if that's the case, then what happens? The credit card company will cancel the debt. They'll send a document to the taxpayer and say, okay, it's been canceled, and the taxpayer is really happy about it. Then it comes tax time. Well, that debt that has been canceled most likely is going to be reported as cancellation of debt. And the justification behind that, Congress has come up with this for many years. They said when you have been enriched, i.e., you've had goods and services that you've acquired and you haven't paid anything for because you used your credit card, then you've been economically enriched. And when that debt is canceled, then that means you're going to pay income tax on that economic enrichment. So you may see that from time to time. It starts to get a little busy, but the bottom line is some of these are out of scope, which means if the debt has been discharged in U.S. bankruptcy court, that's out of scope. If the taxpayer is insolvent, and insolvency is easy to calculate, this is before the debt's canceled, you take all of their assets, you subtract all of their liabilities, and if it's a negative amount, that means they're insolvent. And so that insolvency is something we don't handle in the VITA program. The qualified principal residence indebtedness, that's in publication 4012. It's in pages EXT, I guess it means extension or extenders 3 through 8. And you will see that from time to time. I think right now, I think we'll bounce over that, but we do come back. We will have sale of a residence in the Zoom sessions. Not today, though. Other items, prizes and awards, you're going to see this. And again, when someone says, I've won a prize, I've won an award, the way I think is, okay, then it's all included income unless otherwise accepted. And so if there's something in the publication 4012, if there's something in the publication 525 where it describes this particular item is accepted, which means it's not part of gross income, then so be it. We're not going to go ahead and report it. But the general rule is when someone comes in with a prize or an award, it's a taxable amount. Miscellaneous income, there's all different types of miscellaneous income. And when someone has miscellaneous income, you have to find out what is it. And that person received that income. And so obviously that's going to be the best information you're going to get because they've received it, they know how much they received, and they know why they received it. So they'll explain it to you. Here's something, and this is, if I remember correctly, I believe it's still in scope. Reporting fair market value. And I'll give you an example. I was with a buddy of mine one time. His wife came in and she announced, hey, she won a big screen TV at work. Well, that's great. And then, of course, we set it up, and then she says, "Hey, Jerry, is this big screen TV? Is this a taxable event?" I said, "Yes, it is. That's called a prize." And so, what you're going to do, you're going to report what is called a fair market value. If you want to, you can report what is called the MSRP, the manufacturer. I forget what basically what the company says it's worth, or you can report the fair market value. And she goes, "Well, the MSRP is more than the fair market value." So the only requirement you have then is reporting fair market value. And that's what she did. And she reported that and she was good to go. Jury duty, you see that. It's not a big deal, but when people receive jury duty pay, step one, you report the payment. If you relinquish the check to your employer, which happens from time to time, step two, you report what is called an adjustment to income. And so, for example, I'm a wage earner. I teach at a couple of colleges. I'm also self-employed. So if I get called to jury duty, I don't have to turn my check over to anybody. I can take my big check of $100. I can cash it and do what I want. That means step number one, I'm going to report the payment. And I don't go to step number two because I'm not turning my check over to anybody. I'm cashing it and spending it. And then this is something that you'll see from time to time, and sometimes your clients will get frustrated. And I'll tell you a quick story on that. There are a lot of things that are in scope and a lot of things that are out of scope. And when people say, well, why can't you do this? And the answer is, it's easy. We've been told by the IRS there are certain things that are out of scope. And so, for example, preparing a partnership return out of scope, we're not trained to do it. Certain items from a partnership, i.e., income items, are not reported by us, VITA people, because it's out of scope. And my wife says it the best. Do you want to go to a mechanic and have the mechanic work on your brakes on your car when the mechanic has no training on brake repairs? And your answer is obviously, of course not. And that's kind of like the thing in the VITA program. We're not trained on many, many different things. And so we stay within our lane, and it may be frustrating for the client. But bottom line, if it's in scope, we'll help them out. If it's out of scope, then we're going to have to tell them we can't help you. And then you've got other options as a taxpayer, but we cannot help you at the site. We're not trained to do that. And then when you're talking about what is called a K1, and you'll be introduced to this in the training. A K1 is a document that's issued to taxpayers when they are a partner in a partnership, or they are a shareholder in a corporation, or they are a beneficiary in a trust or an estate. And trust or estates are 1041s. An S corporation, which is a corporation, is 1120S form, and a partnership is 1065. And so the K1 will be issued to the taxpayers, will come to the VITA site, and only certain items are going to be in scope for us. And those certain items are listed. Typically, it's going to be dividends and maybe interest on the K1. That's typically what we use. And so again, we don't, when we get that K1, which has all sorts of items on it, usually we're going to look in the 4012 real quick and say, wait a second, this particular item is out of scope. We cannot help you. And this is really important. You don't want to open up the gates, because once you open up the gates and you do something that's out of scope, then that person is going to tell all their friends, and you're going to get inundated by out of scope taxpayers. So you just have to be firm and polite and just say, your particular return is out of scope and we can't help you. Here's some options. Okay, Schedule A, itemized deductions. And the way I like to describe itemized deductions, it is a laundry list of items that Congress has come up with. And if you can itemize, generally, if those itemized deductions are greater than a standard deduction, you'll take the itemized deductions. And you don't see this a lot on returns, because about 7 years ago, the tax law changed significantly. Essentially, it doubled the standard deduction. So not many people take itemized deductions. I think it's about 9 or 10%. And so when you see it, you'll be able to run through it based on your training and, of course, the publication 4012. But here are the things that you will see on a Schedule A if the taxpayer itemized. Medical and dental expenses, and I like to use the term out of pocket. And so, for example, I've got medical insurance, I pay premiums. Those premiums that I pay are out of pocket. When I go to the doctor and I visit the doctor, and the doctor says, okay, before we see you, you got to pay your copay of 20 or 30 bucks. Okay. So that's an example of out-of-pocket expenses. Your dentist, you go to the dentist, you pay $1,500 for some dental work out of pocket. There's going to be medical and dental expenses. Here are some other things that you may see. You may have someone in the hospital. Like I was in the hospital last year, and so my wife drove me to the hospital, and she picked me up from the hospital. And so those are medical miles, because my wife and I file a married filing joint return. And so that's 21 cents a mile. You get parking and tolls if you pay those. You might have long-term care premiums. That's real popular, especially with some seniors. You can take a deduction for that, because that's a payment of premiums. There's a limited amount that you can pay. Excuse me, there's a limited amount that you can deduct, and that's reflected in your 4012. And then other things that you probably don't even think about. You get eyeglasses. That's also out-of-pocket expense. Hearing aids, if you pay for your hearing aids, out of pocket. Nursing services for seniors. I had one client paid, I think about $60,000 for nursing services. he was in a bad way and he needed nursing care almost 24 hours a day. And nurses are not cheap. And then I've had a couple clients who had guide dogs. And so with the guide dog, that means your veterinarian bills, you're feeding the dog, you're caring for the dog. All of those things are included in your medical expenses. And then things that are not deductible, think this way. Medical and dental expenses bring you back to your whole state. And so you break your leg, you go to the hospital, they fix it, they put a cast on, that brings you back to a whole state. Well, things that IRS, or I should say Congress says don't bring you back to a whole state. Teeth whitening, not really medically necessary. I mean, it looks nice aesthetically, it's great. But if you get teeth whitening, good for you, not deductible. Maternity clothes, babies are great, moms are great, but maternity clothes, not deductible. And then cosmetic surgery, you see this from time to time. If you have someone who's got some type of cancer and then they've got some type of surgery to bring it back to a whole state, that is not considered cosmetic surgery for the purposes of the medical deduction. But let's say you have someone, a young person, who wants to get enhanced in some particular way, and they pay $10,000. That's cosmetic surgery, and that's not going to be deductible. And then for state and local taxes, this is something that this has changed. You want to keep a note on this. The One Big Beautiful Bill Act, it changed the so-called state and local income tax, or state and local tax is known as SALT. And so that deduction has increased from $10,000. So that's a good thing for taxpayers. And you'll see this on your Schedule A returns. And then also in the VITA program, if you don't want to take a deduction for state and local taxes, you can then take a deduction for what is called a sales tax deduction. I don't see that very often. That's something that's there, but typically your bang for the buck is going to be state and local taxes. And then, of course, other things that you can deduct, your real property tax that you pay, and then personal property tax. And if you look at your Department of Motor Vehicle bill, you're going to see a little verbiage that say this may be allowed on your tax return or deductible, and that's the portion that you can take on your DMV. Other things, and this is something that for a Schedule A, the vast majority of the time, individuals will have a mortgage on their property, their personal residence. And generally, this is not something that's super complicated, although it can get a little involved. And so typically, the 1098 will be issued to the taxpayer, and this is interest that's paid by the taxpayer to the mortgage company. And usually the 1098 is your go-to document. Reverse mortgages, they're very popular with certain people. If I remember correctly, I think you have to be 62 years of age, and a reverse mortgage is a loan, and it's not taxed. And so when you get a reverse mortgage, you sign up, you sign a contract, and your company sends you a check every month. And there's certain provisions, and then after a certain period of time, they want their money back. Or if you've passed, then of course the home is sold and they're going to get their money back. But a reverse mortgage, i.e., the monthly payment, it's not taxed by the IRS to the taxpayer. It's a loan. And one thing about loans, it doesn't matter what type of loan you get. You can get a loan for an automobile, for college, you can get a loan for furniture. Loans are not a taxable event. You can borrow, if somebody wants to loan you money, you can borrow away. But if you don't pay back a loan, then you might have what is called cancellation of debt. And then points, this is something that you'll ask about. When you purchase real estate, you're going to pay some type of fee, and that's called points. And the general rule is most people aren't even familiar with the general rule. The general rule is you're going to amortize your points. And so here's an example on the screen. Let's say you pay $3,000 in points to get your loan. Let's say your loan is 30 years. That equates to $100 a year for amortization. And most people say, well, that's not going to work. I want to take the entire amount. Well, you can. That's called the exception to the general rule. And so that's going to be a choice that the taxpayer is going to make, whether they want to amortize or take the exception to the general rule. Okay, I'm going to hesitate for a moment and see if Robert has anything or if we have any questions that we need to address.
We do have a few questions. The first question is, are retirement plans loans different from distributions in how they are handled by taxes?
Well, I guess they use me as an example. So you may have a retirement plan, and based on various items, you may be able to borrow money. So I had a retirement plan one time, and I wanted to borrow money to buy a house, and so that's what I did. And so when you borrow that money, you're going to pay interest back to that retirement plan. But that's not considered a distribution. Now, if you don't adhere to the contract, then there is a distribution at the end of the day. But generally, let me restate that you can borrow from some retirement plans. I'll put it that way.
Okay. And then another question, it says clarification on itemized deductions. Example, if a standard deduction is $10,000 and you have out-of-pocket medical expenses of, say, $25,000, can you deduct the full $25,000?
And the answer is no, because, and let's go back to the medical expenses. Your medical expenses, you're going to key that into the software. And then what happens is under the tax law, there's going to be an amount that will be subtracted from medical and dental expenses. And that's 7.5% of your adjusted gross income. And so the short answer is no. But the vast majority of in that example of your medical expenses will be able to be deducted.
If we take the sales tax deduction, do we need receipts?
The question is, if you take the sales tax deduction on the Schedule A, do you need receipts? And the answer is no, you don't. But you certainly want to keep them because in the unlikely event you get examined by the IRS, they're going to say, okay, you've got $8,000 of sales tax. How did you calculate that? Now you can use the plug figures, and that's one thing, or maybe you're going to use the actual amount that you paid, and you're going to have documentation. And one thing about documentation, whether you are a VITA client or you're one of my clients in my paid practice, as a VITA client or a taxpayer, you want to maintain your documents. And generally, you're going to keep them for 3 years. That's the general rule. But keep in mind for the sales tax deduction, if you take and there's another term for it, it's there's a chart in the instructions to the 1040. If you use the amount from the chart, you don't have to keep your sales tax receipts. But if you use the amount greater than the chart, you have to keep your receipts. Was that it, Robert?
Oh, there's the last question we've already addressed, and that is the Lincoln Learn. The certification tests have not yet been posted. The website is up and running. You just can't take the test yet.
Yeah, and
And
I'll be the first to admit it's a little frustrating. We want to jump on it. We want to certify, but I think what happens is you're going to get experience through these particular Zoom sessions. We're going to do some tax preparation, and once the site is up and running, you'll be able to certify. No doubt in my mind.
and you can always just take the tests in the books, write down the answers, and when it opens, you just pop it in.
Yeah, that's another thing. And again, I use the 6744. I use it every season. I get it. I look at the questions and I find the answer, write it down, circle it. And then when I'm ready to certify, it's just a matter of entering in it and then hit submit and passing it.
All right, that's all the questions we have for now.
Okay, great. Okay, let's go. We started a little late, so we can probably go for another 10 minutes at least. We're talking about charitable contributions. And charitable contributions talked about in the 4012. This is one of your go-to publications when you talk about charitable contributions. And then the VITA program, it's very limited because charitable contributions, there's just certain things that are out of scope. When you talk about charitable contributions, it has to be to a qualified charitable organization. And so I'll give you an example. Let's say tomorrow is Sunday. I wake up and I decide I am going to be a self-anointed pastor. And I anoint myself as a pastor. I open up my garage door and I start proselytizing to whoever drives by. I am now a pastor and I'm taking donations from people. And those donations are not to a qualified organization. They're just to Jerry, the self-anointed pastor. In order to be qualified, you actually have to apply to the IRS. You have to submit paperwork and say, this is what we're doing. And then the IRS reviews it, and then they deem you to be a qualified charitable organization under the Internal Revenue Code. And then you can start taking those donations. But you will see individuals who are not qualified, like Jerry, the self-anointed pastor, but a lot of your organizations are qualified. And if you have any doubt, you can go and jump into the IRS website. There's a search tool, and there are tens of thousands of charitable organizations in the United States. And actually, some of them are overseas. But when someone says, I've donated money, I usually ask for what is called a tax exempt identification number. And if they can't provide it, then we do the organization search or use the organization search tool to determine if it's a qualified charitable organization. So, for example, St. Killian's is a qualified charitable organization. Goodwill is, Red Cross is, and some are not. And so that's why you want to be careful if you want to take a tax deduction. We'll talk about non-cash contributions. An example would be, let's say, like recently, I donated furniture to I think it was the Goodwill. And of course, the furniture is not cash. And so that would be considered a non-cash contribution. It's $500 less. That's within the VITA program. And usually your maximum amount that you can take is 60%. You're rarely going to see that in the VITA program. If someone's making $50,000, well, it's 60%. That's a big chunk of change. You're just not going to see that. Most people donate maybe $2, $5, $6, $7,000, something like that. But here's another thing. People can take that 14 cents a mile for charitable work, and we're going to talk about that too. And so I used to work for a nonprofit. My boss would give me the assignment and say, Jerry, here's the assignment. Go out and do good things. And then I would say, okay. And he says, Jerry, you are not going to be reimbursed by the charitable organization. You can use your own car, your own gas. You're not going to get any pay. You're not going to get any reimbursement. I said, okay. And I went and did it. Well, that means my time's not worth anything. I can't deduct that, but I could deduct, and I did deduct 14 cents a mile for charitable driving. Again, we already talked about the search tool. The one story, we had a lady one time, this is years ago, she donated $8,000 to an organization. And I'm looking at it and I'm thinking, I've never heard of this thing. And I did the search tool and I broke the news to her. I said, this $8,000 that you donated was not to a qualified charitable organization, which means you can't deduct it on your return. And she goes, okay, understood. And so that was kind of a bitter pill. But then, we realized if you're not sure, check the search tool. A couple examples, and this probably bears note because you do see this from time to time. Usually, and I'll use the term generally, your houses of worship are going to be a qualified charitable organization. And I'll give you an example. Jerry, the self-anointed pastor, he's not qualified. He just opened up his garage door and he's proselytizing. That's not qualified. He has to go through the process with the IRS. And again, there will be a tax ID number that'll be issued to him. Other things that you see, schools, you'll see that. Another examples, United Way. I've donated to United Way. I don't think I've ever donated to the Red Cross, but Salvation Army, I've given them stuff, and Goodwill, I've given them stuff. So those are charities. And if you're donating, or if the taxpayer is donating like furniture, like I donated a couch, a love seat, and something else. And then what happened is they picked it up and they gave me a detailed receipt and they listed out all of the things that I'm donating and the approximate condition it's in and the approximate fair market value. But that would be a non-cash distribution. And then other examples, if you donate, like I was overseas one time, I'm an American citizen and I'm in Belgium and I forget what happened, something bad. And I think they had a United Way person. I said, hey, I want to make a donation. She goes, okay. And I only had euros on me. She goes, yeah, we'll take them because we'll just convert them. And so I donated euros, foreign currency. And then, of course, I just converted on my US tax return to US dollars. And that was it. And then we hear the term cash a lot, and accountants, when they use the term cash, what an accountant is talking about is currency, green dollar bills, coins. If you make a direct debit, that's cash. A Zelle payment, that's cash. Or you use what is called a negotiable instrument, check, a money order, a postal money order. That's all cash. And so when you donate or someone donates those items, that's considered cash, and that's a cash contribution. Other things, let's see, probably, I think that probably takes care of it. That's about all you're going to see, I think. Okay, qualified charitable distributions. We talked about this. When you do see it, usually it's going to be maybe five or $10,000. And what will happen is someone's going to be in a retirement plan, and they're going to instruct their trustee, their administrator, to transfer monies from the retirement plan directly to a qualified charitable organization. And when that happens, and that's a qualified charitable distribution, which means it's not taxable to the taxpayer, and the taxpayer cannot take a deduction on their Schedule A. And there's a limit, the very high limit. I don't think we're going to see this in the VITA program, but the limit for 2025 is $108,000. Okay, we're going to get through this one, Robert, and then we'll take our first break. And so, non-deductible charitable contributions, you're going to see this all the time. It simply means that you're helping people out, but you're not going to be able to take a deduction. So, my sister, I think she still does this. She buys and makes sandwiches with a small group, and she lives in Los Angeles. And they walk around in this area and they hand out food to homeless people. And I'm thinking, okay. And she says, "Well, Jerry, can I deduct this?" I said, "No, you can't. You're giving money to individuals, and they're not qualified charitable organizations." I had a taxpayer who tried to donate or try to take a deduction for a political donation. You can donate money all you want, but it's not a qualified charity. Social clubs, I belong to a social club and I pay an annual fee, and I can't deduct that. Now, the social club that I belong to has a nonprofit foundation, and I've donated money to that, and that would be deductible. Homeowners associations, that's not a deductible item, and you can't take a deduction on your Schedule A for that. If you buy a bingo or a raffle ticket, that's not deductible. If you donate blood or plasma, and never donated blood for various reasons, I guess. I've donated plasma though, and you can't take a deduction for that. Now, if you drive to the Red Cross, you can take that mileage that we talked about. But if they come to your place of work, then you cannot deduct the value of your blood. And your services, you may think that you're worth a lot of money. I think I'm worth a lot of money, but you donate your services, and I've donated my services many, many times on a tax return. It's not worth anything. You can't impute an hourly amount on your tax return.
All right. Did you want to answer a question or two before we start?
Oh, sure.
Okay. So the first question we have is, uh, does every Catholic church parish have its own registration number, or do they all fall under the Roman Catholic Church? For
I think the best answer I can give you there, I don't think that the Roman Catholic Church, which is headquartered in in the Vatican, I don't think it just has one tax exempt ID number. I think it probably gets down, maybe not to the individual church, but certainly maybe diocese. But I imagine there are multiple. But the short answer is there's not just one tax exempt ID number for what we know as the Catholic Church.
all right, and then in tax layers, should we do the sections in chronological order, or can we? Is there any specific section we should do first?
You know, I think you want to follow the software where you start off with the administrative data, and then you're going to start off with that first page where we showed you last week. It starts off with the W-2, which is the wage and tax statement. And then you're going to have a procedure. And usually what I do is I follow the software, go through all of the income items first, and then I go to the deductions after that. and then payments after that. But yeah, usually there is a way to do it, but typically you'll start with income.
All right. And when it comes to evaluating items being donated, other than the MSRP, how do you figure fair market value?
That gets a little bit more involved, but bottom line is when you talk about fair market value is what someone is willing to pay for something else, and there's no collusion. So for example, I'll give you a quick example. When I worked at the IRS, the lady she won an automobile, and the MSRP I think on the car was $80,000. And she goes, well, this thing, I can buy it at a dealership for 75 or 72,000. I said, okay, well, then your fair market value would be perhaps maybe some type of listing or advertisement from the organization where the car is listed at $75,000 as opposed to the MSRP of 80,000. And so that might be an example of fair market value.
Okay. And can you claim medical miles if you're using the standard deduction?
No, no. If you're using the standard deduction, that precludes you from utilizing itemized deductions. And of course, medical miles are part of itemized deductions.
All right, I think we're good for now.
Okay. All right. So let's talk about gambling losses. I think I mentioned this last week in the VITA program. For whatever reason, a lot of people gamble. They buy lottery tickets, they go to Vegas, they go to the Native American casinos. And so when you have gambling winnings, you're going to report that on your return. And when you have gambling losses, you can take losses up to the amount of winnings. Now we're talking tax year 2025. That is going to change. But for tax year 2025, you're talking about up to the amount of winnings. And if someone claims to be a professional gambler, usually they don't know what they're talking about because you will rarely bump into a professional gambler. I've been doing taxes in some form or fashion for about 40 years, and I think I've run into maybe three professional gamblers. You're just not going to see them. And here's another thing: professional gamblers are not coming to the VITA site. They're going to go to a paid professional. But non-professional gamblers, i.e., recreational gamblers, they've got to keep records of their losses. And then for tax prep, sometimes people pay tax prep fees and they'll come to the site and say, yeah, I used someone and I paid last year, but I'm aware of the VITA site now. And so that would be something you obtain from the taxpayer, and then you're going to enter that into the software in the federal side of the house. And what happens is you can't take a federal deduction for tax prep fees, but it's going to be carried over or rolled over to the itemized deductions on the California return. All right, let's talk about business income. And you'll see, I don't know what the percentage is, but at the site that I work at, it's probably about maybe 10%. So we're going to talk about a sole proprietor. And when you have someone who's a sole proprietor, they could be a dog walker, they could be a tutor. They are not in a partnership, they're not incorporated. And some small businesses, it's a very low bar to open up. In some cases, you don't need a license, you don't need a permit. Now, obviously, you want to be skilled in whatever profession you're doing, and sometimes it's very easy to get into a profession. Other professions to get into, you have to be certified or licensed, and sometimes there's a lot of training that goes into it. So, for example, a dog walker. I'm not aware of any training for dog walkers. You probably want to have some experience, but literally, you could, I guess, wake up tomorrow and say, I'm a dog walker. And then you would be a small business owner. But anyway, talking about small businesses, there's a great publication, the 334, that talks about small businesses. Again, not incorporated, not part of a partnership. And there's various chapters, and the chapters, we'll talk about some of these chapters, But usually with your small business owners, they usually have issues trying to determine the amount of their income, or also known as gross receipts, which we're going to talk about, and then the type of expenses that they can deduct. And so we'll go through some of those. But this is a listing of all the various chapters in the publication 334. And you're going to get really good at self-employed individuals because you'll see a number of them at the VITA site. Okay, so when you talk about a Schedule C, there's all sorts of terms that people use. I remember the first time someone said, "I got to get my P&L." I'm thinking, "What's a P&L?" Well, that's a profit and loss statement, which is the same as an income statement, which is the same as an operating statement. The way I've been trained, I use the term income statement, but again, they're all the same thing. And then the 1099 NEC, that's non-employment compensation, and that is an information return. And some individuals who are self-employed will receive one or maybe multiple 1099 NECs, and some may not. That dog walker probably gets checks or cash or maybe Zelle payments, and that dog walker probably does not receive a 1099 NEC. Okay, and so here's the takeaway when you're talking about self-employment. You want to determine their gross receipts, which means all of the money that they've received. And again, keep in mind the definition of money, Zelle payments, negotiable instrument, cash, coin. And so sometimes you got to define that for people. And once you determine, okay, once you define what gross receipts are, they'll say, okay, yes, I did write it down. And sometimes they use QuickBooks and sometimes they use a piece of paper and a pencil. I think I used this example before. I have a client who's a doctor, and the first time I asked him about his gross receipts, he has a big rental, big commercial rental. He handed me a piece of paper that was all scribbled out with pencil. And I'm looking at it and reviewing it. He goes, "Is this acceptable?" I said, "Sure, because you've accounted for all of your gross receipts and you have a methodology of recording gross receipts. Some people have a different methodology, maybe a piece of paper, maybe deposits to a bank, maybe they use QuickBooks. It doesn't matter what methodology they use, they just want to have a methodology. And typically in the VITA program, your gross receipts are going to be the same as gross income. Now, your expenses, this is probably the best way to look at it. Your VITA client will come to you typically with pieces of paper or maybe a piece of paper with all of their expenses listed. And what you're going to do is you're going to determine whether or not these are deductible. And in order to be deductible, they have to be ordinary and necessary. There has to be a business purpose, and they have to be reasonable in amount. And so, a quick example, a dog walker, an example of an ordinary and necessary expense, maybe doggy treats, little, things that dogs eat. They do something good and you give them a little doggy treat. That could be an ordinary and necessary expense. And there's a business purpose behind that because they're walking the dogs. So those are the clients, if you will. And then you buy the doggy treats, I guess, at I don't know, Costco or a doggy store, and that would be a reasonable expense. Um, Other things when you're talking about Schedule C expenses, transportation and travel, that could mean a number of things. So, for example, I'm self-employed in my business, and one time we had a forum, a tax forum in San Diego. So we drove down there, and we had a hotel, and we paid for food, and that's all part of the ordinary and necessary expenses. And so that was deductible on my Schedule C. You're going to see education, and we will talk about the education expenses, but for education for a self-employed individual, if they want, they can deduct certain education items on their Schedule C. And then clothing, that's usually a big thing. There's a term called if the clothing is not adapted to general streetwear. So I'll give you a quick example. Let's say you got someone who's self-employed and they help restaurants sell their products. And that individual, that taxpayer, buys a chicken outfit and wears the chicken outfit and buys a sign, twirls a sign in front of the business. Well, that chicken outfit is special clothing. That's fully deductible. Now, if the guy's out there, blue jeans and a t-shirt, that is not special clothing. So you can't deduct that. And then you can't deduct gifts. You have to, of course, maintain certain type of records. Why are you giving the gift to that particular client? These are some of the things that you see. And then at the very top, and you'll see this again and again at the VITA site, people will have what are called personal and family living expenses. So, for example, after I'm done today, I will probably go out with my wife and we'll probably get some, I don't know, hamburgers or tacos or something like that. And that is a personal expense for me because I'm going to eat and I'm going to run out and grab a meal. Now, if I'm in a travel status, that's a different story. But you'll see individuals trying to deduct personal and family living expenses, and you've got to be able to determine what is a business expense and what is a personal and family living expense. I'll give you another example. I'm a self-employed guy, and let's say for this scenario, let's say I've got a 9-year-old daughter and I'm going to have a birthday party. So I invite all of her friends, or she invites her friends. We get a jumpy house. So I hire Bozo the clown. He comes over and I pay $6,000 for the birthday party. Everybody has a lot of fun. And I just happen to have maybe one or two of my clients who are my neighbors, they show up. That is a personal and family living expense. It's not a business expense, not deductible on a Schedule C. We're not going to get in real detail here, but this is something you will see, and you just want to have an awareness. Your Schedule C taxpayers are going to be, they have to be cash method. They're not going to be an accrual method. You're just not going to see it. Cash method is defined, they're going to report their income when they receive or have actual receipt of income, and they're generally going to deduct their expenses when they pay those expenses. That's what you're going to see in the VITA program. And so you're not going to have what is called bad debt in the VITA program, because if bad debt means someone doesn't pay you for work that you've done, well, that means you haven't collected the income, and under the cash method, you didn't report it, so you don't have a bad debt. Something you will not work with in VITA is depreciation, which is cost recovery, depletion, which is also cost recovery of natural resources, and amortization, which is cost recovery of intangible items. You don't see that in the VITA program. So, for example, someone comes in and says, "Hey, I bought a computer for my business. I want to depreciate it." We don't depreciate computers in the VITA program, so it's out of scope. Substantiation, people ask you, do I need to keep my records? The answer is yes, you do. In the unlikely event you're audited. I forget what the audit rate is. Last time I looked, it was like maybe 1% of all taxpayers. Very few people get audited because audits are expensive. The IRS is a very small army compared to the US population, so there's just not a lot of audits. Here's something that I've seen many times. People say, I've got a cell phone. I said, okay, I use it for my business. Okay, I want to deduct it. Tell me about your cell phones. Well, I've got one and I use it for everything in my life. And that's like me. I've got a cell phone. I use it for my college teaching. I use it for my personal life. I use it for VITA. I use it for my business. I use it for everything. I can't deduct my cell phone unless I get an itemized list from my carrier and I can say, yeah, that's a business call, that's a business call. And so that 60 or $70 a month flat fee, you're not going to be able to deduct it on your Schedule C if the only thing you have is one cell phone, because if you have one cell phone, that means you use it for everything. And I always tell people, everybody, whether you're the president of the United States or you are the dog walker or you're Jerry the tax guy, you have a personal life. And if you got one cell phone, you're using it for your personal life. So you can't deduct your cell phone unless you get an itemized list from your carrier and you can differentiate between your business calls. And that's how it works. Cost of goods out of scope. That means, for example, let's say you're selling jewelry in a shop, maybe out of your house, and you're purchasing jewelry, and maybe you're polishing it, and then you're reselling it, you're marking it up. Well, that would mean the cost of goods for the jewelry is something you would calculate. We don't do that in the VITA program. That's out of scope, and uh, and so and there's different ways to value your inventory. FIFO, which is first in first out, LIFO, which is last in first out. Those are things again outside of the scope of VITA. We don't do that. Vehicle expense, very popular in the VITA program. And so there are two ways to calculate vehicle expense. One is called the actual expense method. this is out of scope. We don't do it in VITA. And if someone says, well, I've been doing actual expenses, we say that's out of scope. What we will help you with is the standard mileage rate. And the standard mileage rate for tax year 2025 is 70 cents a mile. And the important thing is they have to have some type of accounting, a list of the miles. And if someone says, well, I don't know how many business miles I drove, then I look at them. Of course, I want to be polite and respectful. I said, well, it's your return. We're going to help you with your return. And so you can reconstruct, whip out a calendar, and let's go ahead and see if you can determine your business miles that you drove for your business to visit your clients or conduct some type of work. But again, 70 cents a mile, very generous. And then you could also add your business parking and tolls. And so, for example, I've got clients in Newport Beach. I'm a Schedule C guy, and I drive to visit them, and I have to pay this toll. I forget what it is. It's the toll road. And so that's clearly a business expense. And the one time I visited a client and I had to pay 20 bucks for parking, thinking, well, okay, I'll pay it. And that's clearly a business expense. And then if you got an automobile that you use only for your business, you can deduct your car loan interest, you can deduct the personal property tax, a DMV. You can do all that if you're using it, in this example, 100% for business. And the one thing about your standard mileage rate, keep in mind documentation. In the unlikely event you're audited by the IRS, the agent's going to ask you, how did you calculate your business miles? And if the taxpayer says, I don't know, usually the auditor will say, well, let's reconstruct. You need to do it because you're the business owner. You're the one who drove the miles. And usually that can be done. And we do that in the VITA site. But again, at the end of the day, that taxpayer has to put on that accountability hat and say, okay, let me calculate it. And that way you can go ahead to help them determine the business miles that they can take. Other expenses, there's all different types, and you just got to remember, is it ordinary and necessary? Is it reasonable in amount? Is there a business purpose? So give you an example where something is ordinary, necessary, there's a business purpose, but it's not reasonable. I'm in a tax business. So let's say I hire my 9-year-old daughter who has graphic skills to go ahead and complete a one-page I guess you'd call it a handout for my tax business. I'm going to post it at coffee shops. And my daughter says, okay, Dad, here it is. And I look at it, says, great job, kiddo. Took her maybe 20 minutes. She goes, okay, you got to pay me now. How much? It's only $9,000. Okay, let me write you a check for 9,000 bucks. Clearly unreasonable. Compensating a 9-year-old kid for 20 minutes of work, clearly unreasonable. Then it begs the question, what is reasonable? Maybe 100, maybe 200, but not 9,000. And every once in a while, you'll bump into that reasonable issue. But again, there's anything that's related to the business. The dog walker, maybe you're buying chains for the dog. I know dogs wear certain types of, I guess they call them handkerchiefs around their necks, things like that. That could be other expenses. Office in the home, out of scope. Out of scope, you don't do that. If someone insists, tell them that's out of scope. You need to go out in town. They can help you out in town, but we don't help people with the office in the home. And for example, I'm sitting in my office in the home right now. And if I went to a tax preparer in the VITA program, they would say, Jerry, that's out of scope. Can't help you. Schedule C, just a couple things. Self-employment tax, not a big issue. Most people are aware of that if they're self-employed, but new people, or maybe they are young adults. And I'm not making fun of young adults. I was a young adult one time, but young adults may not be aware of self-employment tax. It'll be automatically calculated on your software. Of course, they have to have net income of $400 or more. And this is going to be calculated even though your taxpayer may also be a wage earner. And your software is going to do that for you. But again, that's called the Self-Employment Contributions Act, known as SECA. The Schedule SE will show the amount of the self-employment tax and also what is called an adjustment income, the one-half self-employment tax adjustment. We don't do this in VITA. I think we're limited to one Schedule C, But sometimes people have different lines of work, and so you can share information with them, but you're not going to help them out. Let's say you got a flower shop, and then someone also has a engine repair shop, and two different lines of work, and so that means you would have two different Schedule Cs. Your hobby loss, I think this is something we can help people with. We only report income. We don't report expenses. You'd have to net cost of goods sold against income, but we don't report expenses. Okay, Robert, before we jump into this scenario, any questions or comments?
We do have some questions and maybe even a comment here. Let me start. It says, you mentioned that for clients claiming actual sales tax paid, they should retain receipts. You might tell the folks that they, as tax preparers, aren't required to see the receipts, just advise the client that he or she should retain some.
Oh
You
yeah,
also
yeah. And
mentioned,
anytime someone comes to the VITA site, what you want to do is you want to look at what they have, and then I'll review it and make a determination if it's deductible, and then tell them, yeah, save your documents because, again, in the unlikely event, I can't tell you how many times I would audit people and they go, well, I didn't keep my stuff. I say, well, then what happens is we will probably end up disallowing most, if not all, of your deductions. So keep your documents.
it says, same person also wrote, you also mentioned that the vehicle registration fees are deductible. You might mention that the total, hold on, what happened here? That You might mention that the total amount paid is not deductible, only the portion dependent on the depreciated value of the vehicle, usually labeled by an L on the registration certificate. Not sure
Yeah,
exactly.
I don't know who that's from, but now you're getting in the weeds. We're talking the general rule and what you're going to see if someone pays their DMV and they use their vehicle 100% for business, their DMV fee that's deductible is reported on the Schedule C.
All right. In general, buying and reselling items like clothes, collectible jewelry, etc., is that out of scope?
That's correct because when you buy something and then you mark it up and then you resell it, that means you've got inventory. Cost of goods sold are not allowed in the VITA program.
All right. That's about all we got for right now.
Okay, thank you. So let's jump into a real basic exercise for the Schedule C. If you've got a pencil or a pen, you can jot this down, and I'll set it up for us. So this is a business. This is self-employed business. Again, you're only going to see cash basis, cash method, and we have gross receipts of $40,000. And accounts receivable means you've done the work, you've delivered the product but you haven't been paid yet. So that means there's an outstanding bill. Now, in the VITA program cash basis, we're just looking at gross receipts, the actual receipt or what is called the constructive receipt of income. So if the person received 40,000, that's what they're going to report in their gross receipts. Sometimes there's a lot of generous people out there in the world and they do work for free. So for example, in my line of work, I do free work for people. Not all the time because I have to buy, food and pay my rent and all that stuff. But pro bono work, if you do it, great. You can put a value on it, great. But pro bono work is not part of gross receipts because you didn't receive any income. You just valued your pro bono work. Attorneys do it, accountants do it, tax people do it, all sorts of people do it. Expenses. Here's a laundry list of expenses. Oh, by the way, this guy happens to be a tax person. So various expenses. You can see gym membership. Gym membership, it's $350. And so you have to make a determination if that gym membership is ordinary and necessary, if it's reasonable in amount, and there's a business purpose. And I'll leave that to you, and then we'll talk about it. Daily coffee in this example, this individual drives by some coffee shop and buys a cup of coffee 5 days a week, spends a lot of money, and and goes to work with a big cup of coffee. Cell phone in this example, one phone, not an itemized list. Business miles, a total of 3,000. Remember the 70-cent rule. And business tolls And so based on all of this, take a moment and see if you can calculate net income. Now, this is how you do it. You're going to take your gross receipts that you determine are going to be reported, and you're going to subtract your expenses that are allowed, and the difference will be net income. So take a minute and then we'll talk about it. All right, Robert, any comments or numbers yet?
I did have one answer. One person put in 3175. Where'd it go?
Three one
Hey
seven
Robert, yeah,
five.
we had one person say 31,750 in the
Oh,
Q&A. We
all right.
also had another person in the Q&A say 33,700, and then we also have several responses in the chat box separate from the Q&A. Let me see what that says. So we have a bunch of answers. We have 30,000, 33,250, 3,000 miles, 32,800. So lots of
Okay.
responses in the chat if you guys are able to pull that up.
All right, so we're going to run through this now nice and slow. And so let's talk about what you would report on a Schedule C based on this fact pattern. We have gross receipts of $40,000. That's going to be reported. Accounts receivable, not going to be reported because, again, we have a cash method taxpayer. So we just go in gross receipts. And pro bono work, that's not reported because, again, we don't have actual receipt of that $1,000. So $40,000 is gross receipts. Let's talk about the various expenses. Again, we key in on, is it ordinary and necessary? Is it reasonable and in cost? And is there a business purpose? Tax prep software for this tax person? Yes, it is. Supplies? Yes, it is. Continuing education? Yes, it is. Professional publications in any line of work, whether you're a medical doctor, whether you're a dog walker, whether you're an accountant, there are publications, and whether they are paper or electronic, those are allowed. So that $300 is allowed. A business mailbox, very popular, very common. That's allowed. Gym membership, that is a personal and family living expense. That is not allowed. Your daily coffee. Hey, I'm a coffee guy. I love coffee. That's not allowed. That's a personal expense. Your cell phone, where the individual has one phone and there is no data, no information regarding an itemized bill, not deductible. Business miles, you take that 3,000, multiply it by 70 cents a mile, and that would give you a deduction of $2,100. Your business tolls, where you're in a business mode and you're driving to clients, that's fully deductible. And so the net income would be the difference between your gross receipts and all of the allowed expenses, and that would be 33,250. And Robert, did anybody get it?
There were a few people that did get it. Yes, quite a few got
Capture those names, and they can be your instructor next year after I retire.
it. Very good.
Okay. All right. Let's go ahead and move on to our next topic. And just a few more things about sole proprietorship. We don't want to get into a lot of detail here, but we want you to have an awareness. And again, cost of goods sold inventory is out of scope. You don't do that in the VITA program. You're going to see the term material participation. That's going to be reflected in your software. And if you are a tax person on this call, I think we have a few, you know about Treasury Regulation, temporary Treasury Regulation 1.469-5T. For the rest of us, we're concerned about material participation. Did you run the business? Did you do the work? And that's generally yes. And so for VITA, you do materially participate. You'll leave that check mark checked. And then for deductions, we've already talked about this. Again, ordinary, necessary, business purpose, and reasonable. Things that you do not do in the VITA program is if you have an employee, we don't handle employment taxes. If you want to depreciate a business asset, we don't do that in VITA. You're going to have to find someone else. And any type of tax preparer, a paid tax preparer, they're going to know MAKERS, which is the Modified Accelerated Cost Recovery System. They're going to know about different types of depreciation, bonus depreciation, Section 179. That's what they do. But we don't do depreciation, which is cost recovery in the VITA program. That is out of scope. And then other things, estimated tax payments, a lot of times, and I've seen this again and again in the VITA program, your individuals, usually self-employed people, will make estimated tax payments. And if they do, most of the time it's both federal and California. And we're going to talk about that today in our scenario. But again, you'll account for that in the software. And then you're also going to see on a tax return for a lot of Schedule Cs, what is called the qualified business income deduction is a 20% of the net income. It's great for the taxpayer, not great for the Treasury. And you'll see that on the return. And so that's a good thing that came out back in late 2017. Sale of a residence. There's a lot of information here. We're just going to talk about a few things. And if we need to, we can certainly have a discussion, but there's a lot of stuff. And I just want to talk about just a few things on the sale of a residence. Here's one of your go-to documents when you sell a personal residence. You see this in the VITA program. And there's a few things that you want to obtain from your client. And one thing you want to obtain is the settlement statement. And that typically is through escrow. And when they purchase the property, usually they're going to have a settlement statement. So those are your documents. And then also you're going to ask about the capital expenditures that they've made on their home. And think of that as a big ticket item. So, for example, if someone buys a home and they decide, you know something, I want a bigger home. So I'm going to hire a contractor. I'm going to pay that contractor $300,000 to build a second story. That is called a capital improvement on your personal residence. And that goes into what is called adjusted basis, which we're going to talk about shortly. But again, those are things that you need: settlement statements and items pertaining to capital improvements. Now, repairs, you're not concerned about that. So let's say someone breaks your window. Okay, you fix the window, it cost you $800. That does not go into what is called the adjusted basis of the property. This is the 8949. And so when you enter data into the software, this form is going to be generated along with the Schedule D as in Delta for capital assets. And again, capital assets, stock, bonds, your personal residence, the refrigerator in your house that you own, that's a capital asset. And if you have a business asset, that's not a capital asset. And in the VITA program, we will handle, or we will work with taxpayers who have disposition of capital asset. And when you hear the term disposition, basically it means they're relinquishing title, they're selling something. A lot of information here, but this again, sale of a home. I'll key in on that second item. They're going to give you an IRS form 1099 S's and Sierra. That's an information return. And one thing about information returns, they typically have the right information. If it's wrong, they can get a revised one or a changed one. But typically, they're going to come to the site with that 1099-S and say, I got this for the sale of my home. And then that will beg the question, do you have settlement statements? Do you have information pertaining to your capital improvements? Oh, and the sale of a home starts on D52. This is my recommendation. At my site, when we have a sale of a home, we usually get our senior individual. She or he has experience with preparing returns with sale of a home. And then we secure the documents from the taxpayer, ask some questions, and prepare that particular disposition of a capital asset. Your home, your personal residence, is a capital asset. This is the basic equation, if you will, or calculation: your selling price, which is your proceeds less your selling expenses, which includes real estate commission. And then you end up with amount realized, and then you subtract adjusted basis. When you hear that term adjusted basis, think of the cost of your home, whatever you paid for it, and then your capital improvements. That's generally going to be your adjusted basis. And then that ends up with your gain or loss. And then if you're qualifying for that exclusion up to $500,000, then you subtract that and then you recognize the amount as amount recognized. Amount recognized then is what you're going to pay your capital gains tax on if you have any amount recognized. Again, the 1099 is going to be a document you need from the taxpayer, along with that document we talked about, the 593 from the escrow company, if there's any withholding. Your settlement statement is going to have all sorts of information on it, to include the real estate commission that's paid. And then this is an example of a settlement statement. There are many different types. I guess settlement statements, I probably looked at maybe 1,000 of them in my tax life. And they're like people, they're all different. Some of them are really goofy looking. Some of them are cryptic in nature, but most of them tell you the story. And so you go through it to determine what is the cost, what is the sale, and what are those items that are included in adjusted basis. This gets real busy real quick. These are increases to basis. Typically, when you're talking about increases to basis, usually this is going to be some of the non-recurring closing costs when you buy the property, and then those capital improvements that you make. And then you have to differentiate between capital improvements and repairs. And again, an example would be that broken window. Like one time, my son, he's bigger than me, he's stronger than me. He broke my front doorknob, not intentionally. He, just kind of manhandled it, and I had to call uh, what do you call those people? The guy that come out and fix a locksmith. There we go. And the locksmith charged me all this money, and I'm thinking, that is a repair. That is not a capital improvement. And so you have to differentiate between that. This gets real busy. If you have someone who, I mean, you can certainly review this. You probably won't have a lot of decreases to basis. You probably have increases to basis. But again, this is all spelled out in your publication 4012. Again, the basic formula, if you will, starting with selling price, and your goal is to get down to amount recognized. Exclusion, think of the exclusion. This is something that came out well over 25 years ago. And if someone sells their property and they qualify for the exclusion, they can take up to 500,000. And so in the VITA program, you're usually going to see the full amount, the 500,000. For single individuals is 250,000, but they have to meet certain rules. And if they don't meet the full exclusion rules, they can take a partial exclusion, which is out of scope, partial exclusion. A lot of information here. Here's the bottom line. When you're talking about the exclusion, they have to own the home for at least 2 years out of the last 5 years. That's typically what you're going to see. And then they have to use the home for at least 24 months of the previous 5 years. And those 24 months do not have to be consecutive. And so that's what you're going to see in your reading, the ownership and use rule. And if they meet the ownership and use rule, then they're allowed that exclusion that we talked about. We're not going to talk about that. It's out of scope, partial exclusion. Somebody owns a home, they live in it for a short period of time, they move for various reasons. They can take a partial exclusion. Out of scope, they need to go to a preparer, paid preparer. Partial exclusion out of scope. You can read this for yourself. 1099. This is the document they're going to bring along with the settlement statements. And then sometimes they may have a story instead of a settlement statement. So if they bought the home 40 years ago, this is what I do. I'll ask them a whole bunch of questions if they don't have the settlement statement. The gold standard is the settlement statement, but sometimes you're going to have a story or scratchy pieces of paper, but the settlement statement is going to be your gold standard. The calculation, here's an example. You've got someone who bought a home, they used it for 20 years, they're a married filing joint, they sold it for $900,000. And then they have these commissions, real estate commissions, and certain costs that go into the what is called the cost of the sale. So now we're at 60,000 for that. So the amount realized is going to be 840,000, 900 minus 60. And then we're going to subtract adjusted basis, again, generally defined as the cost plus your capital improvements, your capital expenditures. And that's 250,000. So the difference is 590, and they meet the ownership and use rule, and they can take that $500,000 exclusion, which means the amount recognized is $90,000. And that's how that works. And for some of these real estate sales of personal residence, it's going to be pretty quick. You're going to be able to run through it. But again, I would recommend probably a senior or an experienced preparer handle this because there's a lot of twists and turns. This is the 593 real estate withholding statement. It has information on it to include, generally, there's going to be what is called withholding at 3.33%, and you have to account for that. So I always ask for the 593 when someone has sold their real property, their home. Okay, capital gains. Let me look at the clock here. Okay. Let's see. Robert, I'm going to see if Lisa Cruz is on the line and she can jump in and do her bit. I think she wants to do it at about 11 o'clock.
Sounds
Lisa,
good.
are you with us? Robert, do you see Lisa on your list?
Hi guys, I do see
Yes, Jerry,
Lisa
I'm here.
Cruz. All right.
Can you hear
All
me?
right, Lisa, I'll give you 10 minutes. Can you finish up in 10?
I'll do my best.
Okay. Well, let me introduce you, Lisa. So, ladies and gentlemen, this is Lisa Cruz. She is a professional tax preparer, and she's also a certified acceptance agent, and she knows a lot about tax. And she's going to talk to us about the individual taxpayer identification number today.
Awesome. Thank you, Jerry. All right. Am I able to share my screen
Yeah, you
I
have to get
just gave
hosting
you
privileges.
co-host permissions,
permission?
Lisa. Are you able to?
Awesome. Okay, let me go ahead put that PowerPoint real quick. And does everyone see my PowerPoint?
Yeah, we
I
can
see it,
see
Lisa.
it. It's not full screen, however, we see it in the
Let me do a full screen
with
real
the
quick.
menu bar and everything.
Let's
I
see.
think if you go back and press the bottom bar of the screen on the right side,
Right
there's the
here.
presenter view icon, very bottom of that screen.
Okay, do you
Um,
see it? My presenter view.
yeah, right there.
Right there. Okay. And you want me to do, how about that?
Perfect.
Awesome. So everyone, again, as Jerry introduced me, my name is Maria Elisa Cruz, a very long name, but you can call me Lisa for short because I am also short in height, but not in knowledge, just like Jerry. Not the super smart, but I know a lot from Jerry, and Jerry and I work together with the California Society of Tax Consultant for California, and we are the Orange County South. We are licensed tax professionals, and I am the president of the Orange County South. Jerry is our vice president. So if you decided to become a licensed tax professional, we are a great community of tax professional that you would like to join. So I am going to be talking about the individual tax identification number today. I am an IRS certifying acceptance agent for the IRS. So there's two category of acceptance agent. One of them is acceptance agent wherein the tax professional or CPA should include an original passport sending to the IRS in order for an applicant to be able to receive their assigned ITIN. But myself, I am a certifying acceptance agent, meaning I passed the forensic exam to be able to certify the passport, and the applicant would not need to send original passport to apply for ITIN unless they are minor, so 16 years old and below. They would need to send the original passport or a certified true copy of the passport. So that's about me, and let's move on a little bit. So the objective of this quick presentation is to describe tax reform that changes and impact the ITIN holder, understand what's the application process for the ITIN and ITIN renewal, understand common error that may delay the processing of ITIN application, explain certifying acceptance agent's role in applying for ITIN. So again, that's we're going to do ITIN overview, tax reform, who should and should not apply for ITIN or renew an ITIN application and renewal process, common error that caused delay, certifying acceptance agent, and that's me. So what is an ITIN? An ITIN is an individual taxpayer identification number. It's a tax processing number issued by the Internal Revenue Service. The IRS issue ITIN to individuals who are required to have a U.S. taxpayer identification number, but who do not have and are not eligible to obtain a Social Security number from Social Security Administration. So if a taxpayer is, they're commonly a tourist coming in the U.S. and extending their stay, and they are participating in self-employment activity like driving an Uber, purchasing a property and renting it as an Airbnb or a rental property. Um, they also do what else? IT, uh, house cleaning, taking care of an elderly. So they are not eligible to receive a social security number, then they have to apply for ITIN. Or if they are dependent of a work visa applicant in the US and social security number is not readily available for them, they can temporarily apply for ITIN. So those are some of the examples. ITINs are not intended for use outside of the federal tax system. Um, in some cases, you can use this to basically open a bank account, especially if the bank account is going to be earning interest, like a savings account. That would be helpful for the bank for you to furnish them ITIN. In that way, they can issue the interest earned on your money that you put in for savings. And in some instances, if the ITIN person who's not eligible for Social Security would like to purchase a car and they built a history already with their bank, and they're issued and they are actually are being allowed to apply for credit cards, they can use that to apply credit cards, and also they can buy car, and the dealership be able to give them a loan using the ITIN number to provide a credit application. And recently, I have two ITIN holders. They were able to purchase a house, not like $1 million house, but a good size of loan. And using an ITIN and a good credit history, they were able to own a home in the United States. So that's one thing. Um, ITIN helps individual to comply with the U.S. tax law and provides means to efficiently process and account for tax return and payment. So again, if the taxpayer was involved in underground business, like they don't have, it's like a cash self-employment, or for the most part, they receive a 1099. These are the self-employed contractors. Then they are required to file the paperwork they receive for 1099 in order for them to pay the tax and the employment tax associated with that business activity. And ITIN is issued regardless of immigration status. So, like what I said, what it is used for, this is for people who's not eligible for Social Security number, and they are definitely not an immigrant, because if you are an immigrant, you are going to be eligible for Social Security number. If you have applied for a student visa, you will be issued a Social Security number. If you have applied for working visa, you will be eligible for Social Security number. If you applied for a business visa, then yes, you are also eligible to receive a Social Security number. So these are for folks, taxpayers that is not eligible in being legalized in the United States. So, I mean, they will be in the future become an eligible citizen or residents of the country. But for the meanwhile, as they decide what immigration path they wanted to take, they are able to get the ITIN. So even asylum seeker or parolee, if they are refugee from other country, they are allowed, or they're eligible for social security number. So for the most part, most of the folks that apply for I-10 are dependents of a work visa or dependents of an existing permanent resident. So, and then the immigration status is not available for them yet, so that's why they will temporarily get an ITIN. Or if someone is adopted and they're waiting for the paperwork to go through, they can apply for ITIN. So basically, yeah, those that is not a legal resident, this is for them, but we should not kind of like judge. These folks wanted to file a tax return. They just wanted to pay the tax dues associated to their self-employment taxes. So we should be treating them like how we treat a taxpayer, a tax filer with a social security number. And apart from social security number, of course, they are not eligible with so many credits, but in the state of California, I-10, if it's a low income, they're eligible to get earned income credit. So an I-10 does not authorize work in the United States. Um, it does not provide you eligibility for Social Security benefits unless the immigration status changes. And I can qualify a dependent for earned income tax credit purposes for the state of California only. But for filing a federal tax return, that would just be a $500 credit for other dependents. So, quick history. So for ITIN in the tax reform, Tax Cuts and Job Act in 2017. In the past, if you have a dependent child, 16 years old and below with an ITIN, it is $1,000 credit that you can get for the qualifying ITIN holder tax dependent, but it changes in 2017. That $1,000 is gone and or suspended, and it is now considered only 500 for other dependent. But for spouses, it will still be the corresponding standard deduction that would be available for that specific tax year. So, next slide. So, who should apply for ITIN? So, the following is eligible to apply for ITIN if the situation applies for them. They don't have social security number and not eligible. They are required to furnish a federal tax return. So they need an ID to file that tax return. Non-resident alien. So basically anybody who would need to file a tax return or needs to become a dependent of a U.S. resident, a U.S. alien, a U.S. taxpayer, either a spouse or dependent child, dependent sister, dependent parent, but they're not eligible for social security number, can be able to apply for I-10. And if you're issued assigned I-10 since 2013, in the past, prior to 2013, if you're issued an I-10, that will be your I-10 number until you change your immigration status and you were assigned a social security number. So basically, there's no expiration date. That was before 2013. After 2013, so we're talking about 2014 and to the current uh, period, if you applied for I-10, if you do not file tax return or use the I-10 as a dependent in another tax return, the I-10 will expire within 3 to 5 years. And in 3 years, it's not used. It will be voided. So you will need to reapply, and then every 5 years it has to be renewed. So that's like changes starting 2014. And if your ITIN is going to expire in the next filing season to file 2025 tax return, it has to be filed and renewed before April 15, 2025. Otherwise, you will not be able to get your standard deduction if you're filing single, whatever your filing status, single, head of household, married filing joint. If the ITIN is revoked or expired, you will not get the credits or even the standard deduction for that tax return. So you may result to owing taxes. So it is important for the taxpayer to make sure that they are within their 5 years period for the ITIN since it was issued. So if the ITIN was assigned or issued in 2020, that is already going to expire this December 31st. And if it is 2019 that it was assigned, then it expired already last year. So that's one thing. So this is in the past that there's particular number that a number is expired, but now since 2014, as long as it is approaching the 5-year mark for when their ITIN is issued or renewed, they need to renew. So it includes the spouses and dependents of the taxpayers. Awesome. So spouses and dependent outside the U.S. who would been claimed for a personal exemption should not renew their ITIN unless they're filing their own tax return. So this is a temporary change since the 2017 Tax Act. So if you have parents living in Mexico, living in Canada, living in Cuba, only one parent would be allowed to be your dependent unless they have U.S. presence, or if your dependent has a U.S. presence, then you can be able to renew or claim them on your tax return. So how to renew or how to apply? You have to, the applicant should complete a W-7 application, attach the original passport or certified copy of the passport if you are not seeing or meeting a CAA, certified acceptance agent. If you only will go to a regular CPA or a tax preparer, anybody who's licensed to prepare taxes, as long as they're not CAA, the original passport, original document has to be mailed in along with the tax return. So again, only the certifying acceptance agent like myself who underwent a forensic passport examination is eligible to send only photocopy of the identification. So that goes with the spouse and dependent. If the dependent is if the dependent is 16 years old below and they're not eligible for social security number, that would require a certified copy of the passport from the issuing country. So for example, if it's a Mexican born child, they will have to go to the consular of Mexico to be able to get a certified copy of the passport. If it's Filipino, they have to go to the Philippine consulate. Whatever country is it, they have to go to their consulate and obtain a certified copy. So what a certified copy is, it's basically just a photocopy of the passport, and then the consulate will stamp authorization proving that it is a certified copy of the person's passport of that consulate. Awesome. Again, if they are not able to find a certifying acceptance agent, I believe in California, there's only two of us that is CAA, and the rest is certifying agent only. The taxpayer can go to the IRS offices one, I believe in Santa Ana, Los Angeles. They would bring the original passport, and that's the Taxpayer Assistance Center or tax. So what do they need? If it's a brand new application, the passport is a standalone document. If it's a renewal, it can be a U.S. driver's license as long as they provide the original entry date in the United States and the assigned IT number. For dependent, it will be on top of the certified passport, it would be including a birth certificate, medical record, school record in the United States, and then the U.S. visa issued by the United States and a U.S. tax return. So this information is basically just to give you a heads up, but it's mostly the certified acceptance agents who will provide this information or answer this information. So I will go ahead, shift a little bit to the application form. So this is the application form. So on the very right upper part, it will be asked here, what type of application is this? Is this an application to renew an existing assigned item number, or if this is a brand new application? So it will indicate there. It is important to select the correct category of the applicant, whether they are a non-resident alien, required to get an ITIN, to file a U.S. tax return, U.S. residents. So when you say a U.S. resident, it doesn't necessarily mean they are U.S. citizen or they're a green card holder. This pertains to their presence in the United States. So if they are here earning money for a self-employment, or if they were issued Form W-2, they are considered U.S. resident in the base of filing a tax return. But this application has no implication with U.S. immigration whatsoever. So if they're a dependent, you have that option. If it's a spouse, you have that option. And then if there's a dependent of non-resident, so the most common use is only U.S. resident, dependent spouse, and then dependent spouse of non-resident. So this is the information to fill in. And the CAA or the TAC from IRS should be very careful in filling up application, because if you misspelled a name, then it's gonna affect or impact the processing time. Processing time is 6 weeks to 12 weeks. So any mistake is gonna add to that processing time, okay? And you would need to furnish the information of the first name, middle name, last name. There are countries that do not have a middle name. There are countries who does not have a first name. There are countries who has no last name. So you got to be very specific and careful checking, verifying the passport, because you don't want to cause that mistake. If the applicant is non-resident and it's not in the United States, you have to furnish the applicant's mailing address in the foreign address in order to make sure that the application will not be rejected. So it needed information on the date of birth, country of birth, gender, so male or female, country of citizenship, and then what information you're providing. Is it passport? And then if it's a renewal of the ITIN, you have to furnish that information here, the assigned number, and that's on number 6F. And if they not necessarily they are a student, if they're a student, they should be eligible for Social Security number. And then the last part, if it's a minor applying for an ITIN, if they're dependent, it will be the guardian or the parent who would sign the ITIN application on their behalf. If it's the actual applicant, it will be them signing the application. And down here below, is only for the acceptance agent use only. In my case, I was actually very lucky to be the very first one assigned a license for the ITIN because of there was a changes on the ITI in moratorium. It was locked from 2023 to early 2025. So they only started issuing number March of this year. So my license number starts with 1 because I'm the very first one who was issued the license. So that's really fortunate of me. Okay, so let's go back to where. Okay, so application will be facilitated by a CA like myself or the IRS TAC. Application can be processed by a regular tax professional, but again, all original document must be included. And for your um, just a little knowledge. So this is a sample of a Philippine passport. So it has their information like the date of birth, what country are they from, passport number, when it was issued, and this is the important information you need for when they applied. So for Mexican passport, if you noticed, the date of birth is arranged differently. Let's just pay attention real quick to the date of birth. It's in a different language on the other side, which is Spanish, and then the right side is the English translation. If you can see the day of the birth is the first before the month, and then the year of the birth. So this one is January 01 17 1981. So that's enero 17 1981. That's for the Mexican passport. And for the Poland, it is similar to the Mexican passport. The date of birth is described with the day of the month first, second of the month, and then January 1981. Unlike the first one I showed you for the Philippine passport. Oh, actually, they're also the same. Yeah. Day first, and then the month, and then the year. So just be very careful in looking for that for the client. So far, we've talked about that, and that's about it. We reached the end of my short presentation. And for your reference, you can go to the IRS website. I'll go ahead and get you to their website. Oh, let me show you real quick the actual letter that a client received when they were assigned for ITIN. It would contain their name on the left upper corner. On this case, it has my name because I am the certifying acceptance agent and I do get a copy of all the applications. And right here, it would show their number. And as you can see, the ITIN starts with number 9. So social security number start with 0 to 8. If it's 9, that is not a social security number. That is an ITIN number. It is 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 digits number. And it should show their name, middle name, last name, and date of birth on the on the assigned number. So again, let me share with you the website. So if you want to know more about ITIN, you can go to the irs.gov, and that would be ITIN, Individual Identification Number. Everything I talk about today, what is an ITIN used for, who needs it, allowable tax benefit, when to apply for ITIN, apply for or renew an ITIN, that's listed there. And ITIN, just like Social Security number, they are allowed to claim as long as they're in the States. They're allowed to receive their standard deduction, their allowable $500 credit for other dependent. In case of the state of California, if they are low income, they're eligible to get earned income credit for California. So I think, Cherry, that's about it, unless you have questions for me.
All right, thank you, Lisa. Appreciate that. And Robert, anything from the chat for
There
Lisa?
was there was one question, and it was, are are we going to be helping people complete the W-7s at the sites?
I think I can answer that. No. But what does happen, there are certain sites where taxpayers will go to, and those sites will help them. With the certified acceptance agents, that's something that a program can expand to, but currently St. Killian's does not offer that.
That's it.
That's
Okay,
about
great.
it.
Thank
Yeah.
you, Lisa. Appreciate it.
And Jerry, if are you only doing every Saturday to process ITIN? I mean, I sorry, tax returns.
Robert has a schedule for St. Killian's.
What you can do is if you have a taxpayer that would need help, because definitely they go to VITA because they have low income or less of income source. What you can do is you can send them to my office. My office, Mr. Robert, is very near to St. Killian. Jerry, would it be like about 2 miles at least? Our office?
Yeah, 2 or 3 miles.
Yeah. Okay. So I am available on Saturdays. I'm in my office on Saturdays as long as they will say that it is coming from St. Killian Vita. I would be able to entertain them.
Thank you very
Okay, then
much.
Lisa, I'm going to conclude that would be a free service for taxpayers who need an ITIN.
Yes.
Okay. Okay, Robert, can you see David and Ali win?
I can.
Okay,
It's
great.
not full screen now.
Watch this. Okay, can you see it now?
Yes, perfect.
All right, great. All right, so we're running short on time, so I want to jump right to tax preparation. And as these sessions continue, we're going to spend more and more time in the software because obviously that's what you're going to be doing at the site. And so let's run through this particular fact pattern. We've got a 2025 tax year. So we've got our date of birth information. We've got our administrative data. Our taxpayer, David, he is a wage earner. He makes $35,000 and he also contributes to his 401k. He also has health insurance that the employer pays for to the tune of $5,000. That covers David and Ali. They do file a joint return. Ali is self-employed and her gross receipts, $25,000. She has various expenses, including business miles, and she also has expenses, including $500 for supplies, and then that personal property tax, that's the DMV. She uses her vehicle full time for her tutoring self-employment. And then at the very bottom, you will see that she makes estimated tax payments to the feds, and she made one estimated tax payment to the state. This is something that I've seen probably well over 2 or 3 thousand times. People will look at me and say, Jerry, why do I owe the government money when I file my return? I said, well, let's take a look. And usually the answer is they did not make estimated tax payments and they are self-employed. You can make, I'm self-employed, I'm also a wage earner, and I make estimated tax payments. And when I was a wage earner only, I made estimated tax payments. So it's possible. But the bottom line is you want to have either withholdings and or estimated tax payments so you can meet that obligation. And the general rule is 90% during the year. So if your tax bill is $10,000 for the year, the general rule is you want to make $9,000 in either withholding and or estimated tax payments to meet that liability. Okay, so this is this, and we're going to run through this real shortly. This is the latter part. For David and Ali, we've got a Schedule A as an alpha. We've got doctor bills. Now, there's an item here that talks about treating their dog at the vet. Well, that is a personal and family living expense. Now, if you have a guide dog, that's a different thing. But this is a pet, and so that's not a deductible expense. But we also have some information regarding the mortgage that they have, property taxes, and DMV, and this is going to be the car registration amount. They make donations in cash, and they also have driven their vehicle, or yes, driven their vehicle for a qualified charitable organization. And then this is new this year for tax year 2025, the so-called new car purchase. And that goes on that statement that we talked about, the Alpha One. So they bought a 2025 vehicle, and they've got a VIN number here, and they paid $2,000 interest on the loan. And then there's Schedule D is in Delta. We're going to show you how you're going to enter data for a capital asset that's been disposed of. Okay, so based on that, let's jump into the software. And Robert, keep me honest. Let me load the page and let me know if you can see the page for the Lincoln Learn software. Okay, hold on a second. Let me unshare that. Let's go ahead and go to our Lincoln Learn software. Can you see it now?
Yes.
Okay, great. Okay, so if you're new or newer, we showed you this last week. This is Lincoln Learn, and to get to it, you have to type in the password, which is Train Pro Web, all one word, all uppercase. So we're going to go to the practice area. You can see right here, this is Tax Program 2025. And if you need to change to 2024 or a previous year, sometimes at the VITA site you'll do 2023, maybe in 2022. But the toggle switch is over here. Now, the only games in town right now for this particular software, this is the practice lab, you only get 2 years. Using the real software, you're going to go back a number of years. So anyway, we're going to go with 2025. And I've already entered the data, so we're going to go to Client Search. And we're going to go ahead and pick our taxpayer, and this is David and Ali Wynn. So we show you how the entries go on this particular tax return. All right, we're going to go to Basic Information. I'm going to start off with filing status, married filing joint. And the 4012 has a description of the various filing statuses. Usually that's not a tough thing for you, not a bridge too far, if you will. Head of household, sometimes you got to ask those additional questions, but typically this goes pretty quick. So we got a married couple. At the end of the year, they're married, so they're going to go ahead and choose that election. We've got our administrative data for David. And he was born in 1980. He chooses to make that presidential election campaign fund contribution. You're going to ask that. That's on the intake and interview sheet, and that's a choice they make. It doesn't change their refund or anything. This is the spouse, Ali. It doesn't matter if you put the husband first or the wife first. It does not matter. She was born in 1982, and she also chooses to make those contributions to the presidential election campaign fund. We've got an address. And then to get past this software, you've got to put in some type of phone number. You're also going to collect the email address from the taxpayer on the intake and interview sheet. Okay, so we're done with that. This is what Lisa was talking about that I stand corrected. This is the IRS Identity Protection PIN. This is for individuals who had their identity compromised, and they've notified the IRS. And we'll talk about that at a later date. W-2, this is going to be for David. That blue and color pencil, this is how you make your revisions. Usually you're going to have a standard W-2. And our employer information, this is going to be for his company called Riverside Enterprise. We've got our employer information on the left-hand side, and you can see that we're going to enter data as we see it in the fact pattern or when you have a W-2. Your EIN, that's your federal EIN, starts with a 33 in this one. We go down to the middle part of the screen and we'll have, you see there's 31,500. He had total wages of 35,000. He had tax deferred income of 3,500. So 35,000 minus 3,500 gives you 31,500. And we'll show you where the 3,500 goes. We have federal tax withheld of 3,000. Box 3, 4, 5, and 6 are going to auto-populate when you enter data in the program. We're going to come down here. This is the amount of D stands for deferred compensation, and that's at $3,500. Delta Delta, that's going to be the amount that's paid by the employer on behalf of the employee, and that's for health insurance. You can see over here, there's a retirement plan. We check that. That's pretty typical with a lot of jobs. And then down here, not everybody pays into California SDI, but a lot of people do. And when it's reflected on the W-2, we're going to enter it here. And that's $200. And then we go down toward the bottom. This is the general rule. Generally, box 1, which is the gross amount for the feds, would be the same amount on box 16. That's the general rule. I think I mentioned last week when I was working and living in Cuba, I had to report my federal wages, but my state wages on box 16 were 0. But generally, it's going to be the same as the Fed. This information over here, the employer ID number from the state, this is issued by the Employment Development Department. So this is going to be different than the EIN. Again, we're going to key in our data as we see it on the W-2. State income tax is 1,000. State income tax withheld. Hit that. And that's the only W-2 we have. We're going to hit continue, and we're going to go to our next screen, which is going to be the Schedule C as in Charlie. And this is a pretty basic Schedule C. Here's our dashboard or heads-up display, if you will. Total income for this particular taxpayer, expenses, ordinary and necessary, and then we have the net income, which is the difference. So we're going to hit that blue and colored pencil. We're going to start off at the very top. This is that basic information. She does not have a doing business as, so all of this data we will leave blank. And we go down here to business type. You're going to see there's a very, very lengthy list of business codes. And so we're going to do our good faith effort, and she's a tutor, so we're going to put down this particular code, and that corresponds to education. And then we're going to go to our next tab, which is questions. Every one of our taxpayers, I've never seen an accrual method taxpayer. I don't even think that's in scope, but cash that's what you're going to see in the VITA program. You're going to leave this inventory item alone because we don't work with inventory in VITA. Here's that material participation question, and that's going to become pre-checked. We'll leave it alone because our folks are going to be running the business and be involved in the business on an ongoing basis. And we're going to leave this item down here where all investment is at risk. We're going to leave that pre-checked. We're going to leave that alone. And then we go to our income item. And remember, we're talking about income that the taxpayer receives. It's called actual or constructive receipt. And so in this case, she had $25,000, and that's all we're going to do there. And we just had a few expenses. We're going to go to general expenses. General expenses, we had some information regarding supplies and her DMV. And so we enter that data here. Supplies and her DMV. She uses the vehicle 100% for business. And then for vehicle is a separate tab. We're going to come down here, car and truck. We're going to enter that information. And it talks about the type of vehicle, when the vehicle was placed into service. And this is where the money slide is, if you will. Her total business miles, she's going to account for that. And this is 1,000 miles. She has no commuting because she is self-employed. Commuting is defined as going from your house to your place of work as an employee and going back from your place of work as an employee to your house. She has no commuting, so that's 0. Other would be all the other trips that she makes. And then down here, it has a number of questions. And it starts off with, do you have another vehicle? Yes, they do. They have a total of 3 vehicles. So the answer is yes. Is a vehicle available for off-duty use? The answer is typically going to be yes. And is there evidence? There's always evidence. There's always some type of evidence out there. And in this case, yes, there's evidence, and the evidence is written. Whether it's written electronically or on a piece of paper, it's all written. So this is typically going to be checked, all 4 of those boxes. Hit that. And then, of course, since we put in 1,000 miles, the software is going to calculate that deduction at 70 cents a mile, 70 cents a mile. Okay, then we're going to come over here to capital gains and losses. And you're going to see this is a short term, and we'll show you how easy this is. So we're going to go ahead and go, you can barely make this out. There's the pencil, and we're going to show you how this works. This is a joint account. She had some stock in this particular company. She bought the stock in 2025 in February. She sold the stock in December of 2025. So that tells me that's a short term. In this case, looks like she's going to have a little bit of a loss. She sold it for $2,000. She bought it for $5,000. Now, when you're talking about capital losses, the general rule is you can take a $3,000 loss. The rest of it has to be carried forward. So in this case, she's got a short-term capital loss. And here's another thing we want to introduce you to. This is typically what you're going to see in this drop-down menu. It'll say 1099-B. That's going to be the document you're going to receive from the stockbroker. That's typically what you're going to check. Okay, there's a lot of information in this software, and most of it on this particular screen you're not going to use. And there's certain things that are out of scope, but you can see there's a lot of different items here. Okay, we're going to hit continue, and then there we go. There's our heads-up display, if you will. And we're going to go to the Schedule A as an alpha. Over here where it says deductions, click there. And then we're going to start off with the medical and dental. And you can see this is where we're going to enter our data for our doctors and our dentists, $1,200. Keep in mind, the software is going to subtract 7.5% of the adjusted gross income. So at the end of the day, they're not going to get anything on that particular deduction for medical. All right, then we're going to go to our next item. Our next tab is going to be our mortgage interest. And you can see we're going to enter the tab there. So for the mortgage interest, typically you're going to look for that 1098, which will have usually the information you need. So they're going to borrow the money to buy or build a home. You're going to enter the data regarding the name of the lender, the mortgage interest that is paid by the taxpayer to the mortgage company. On the 1098, you'll see the outstanding mortgage principal, what's left on the loan, the origination date of the mortgage, and then that's about it. Once you enter that data, you can hit enter. I stand corrected, continue and move on. Now, if you do have property tax, whether it's paid for let me restate that. When the taxpayer pays property tax, you're going to take a deduction. If there's an impound that the mortgage company is insisting on, that means the mortgage company will take that money from the taxpayer and make payment to the county assessor. And that's what we have here on the 1098. So in this case, this is property tax that's paid by the mortgage company on behalf of the taxpayer. And of course, the mortgage company collected that property tax in advance from the taxpayer. All right, so that's our display right here, interest and real estate taxes. Okay, our next tab is going to be taxes paid. And this is where you're going to look at the DMV bill, and you're going to see the amount of of tax that is allowed to be deducted. And it's usually going to be reported on the DMV bill where it says this can be or is the deduction. And so that's property tax. And that's all we're going to do on that particular screen. And hit entry. Now keep in mind another tax is that state disability insurance that carries forward because we made the entry in the W-2. It carries forward automatically to the Schedule A as an alpha. Gifts to charity. We're going to open that up. This is pretty basic. We have the name of the charity. We have a cash donation. And let's say they gave throughout the year. The only game in town utilizing this software is one date. So I just picked a date in 2025, and then the amount that was donated by the taxpayer, $3,500. And then we are going to hit continue and go to our next tab that says non-cash gifts to charity. In this case, they drove charitable miles, 4,000. So the software is going to look at that. They're going to apply the charitable rate, and there's going to be a deduction that will be reflected. Okay, we're going to hit continue. And then we are going to go to the Schedule 1A. This is the new schedule that we introduced you to last week. And we had a car loan. The individuals purchased a vehicle, they financed the vehicle. And so we go to this information in the new car loan. You're going to have to ask for that vehicle identification number. That'll be listed on the sale document from the dealership, the date that the vehicle was purchased. And in this case, this is used for personal reasons. And so this is going to be amount that's going to be deducted for the interest that they paid, the $2,000. And it's as simple as that.
Jerry, may I ask a quick question? Will the taxpayers receive a document from the bank showing the interest paid for the car purchase?
They should because obviously there are all different types of financing available. But they should receive some type of document that this is the vehicle, this is the balance on the vehicle, this is the information to include the interest paid in tax year 2025. All right. And then we're going to bounce over to the estimated tax payments. I'm over on the left-hand side of the screen. Hopefully you can see my cursor where it says payments and estimates. We're going to click there. We're going to go to federal estimated tax payments, this tab right here. And we're going to open that up. And then you can see, and you'll ask about this, did you make any estimated tax payments? And a lot of times self-employed individuals do. And so you'll enter the data based on when they made the payments. And that is reflected here. The last one is due in January of next year for self-employed folks for tax year 2025. So that's federal. And then a lot of times individuals will also make a state estimated tax payment. So we come down here where it says state estimated tax payments, open that up, and you can see where we've got a payment made in June of 2025. And we click there. And then we go to insurance, and you have to remember every taxpayer, you have to enter some data regarding insurance. So we're going to click on insurance. And we know that the taxpayer has their insurance covered by their employer. So we're going to check no where it says, are they covered under the Affordable Care Act? This means if you're in covered California, basically. And we'll talk about covered California later. But in this case, they're not in covered California. So the answer is no. And let's see, Robert, because we're running out of time, I'm going to go right to the tax return. Work in progress, state of California is not available. What it is, we're going to go through that for 2025. But let's go to our summary. And let's show you a little bit of the return here. Make that a little bit bigger so you can see it. This is your 2025 tax return. We've got our administrative data at the very top. We have indicated they're married filing joint. There are no dependents for this taxpayer. They had wages
I got a few questions. Going back to the house purchases, does the adjusted basis include commissions and closing costs?
When you're talking about the sale of a personal residence and you're talking about the selling expenses, it includes the commission when you purchase a house. And usually when you purchase a house, you do not pay a commission. Usually when you purchase a house, the seller is paying a commission. So you're probably not going to see that.
Okay. Uh, there was a comment here says I completed a W-7 for a taxpayer with his return. He took the paper return to the IRS office to get his I-10. This was at St. Killian's. You were required to have 2 international certified people to do that. That's just a
Oh, did I hear you? Yeah, you need to have documents, and so typically you might have a passport from the country the individual is from, and then maybe a national identity card, something like that.
Then if someone asks if they fixed the standard deduction in the practice lab, it was incorrect yesterday.
I would have to plead ignorance on that. But here's the
All right.
important thing. When you get the real software is going to be ready to go. It's going to have the correct standard deduction. The practice lab, it does have issues with it. I don't know why, but it does have issues with it. And so that I always call it a work in progress. And so I think I wouldn't really worry about the dollar amount right now. I'd worry about the mechanics of making entries and preparing a return, because that's what you're going to do at the VITA site. You're going to analyze data, you're going to make decisions, and you're going to make entries in the software.
Can taxpayers deduct oil changes for car expenses?
They can under the actual expense method, which is out of scope in the VITA program.
All right. Could you remind me a sale of stock in an employee stock purchase plan that involves income from the sale as well as a gain? Is this within scope?
I can't remember right now, but I'll tell you what, Robert, jot that down, and what we can do, let's tackle that the next time we meet, which is in 2 weeks, and we can talk about ESOPs, employee stock ownership plans, and disposition of stock that you obtain as an employee.
All right. And then what topics should we study out of the 4012 for next week or 2 weeks from today? There's no meeting next week.
Correct. So next week, let me get this up on the screen here, Robert. Next week, we are going to go dark, which means there's no meeting. The next meeting is going to be December 6th, and we're going to talk about the Child Independent Care Expense Credit. You're going to see this all the time. We're going to talk about education credits, and that's both the Lifetime Learning Credit and the American Opportunity Tax Credit. Talk about the Child Tax Credit. You'll see that a lot. And then the big one, the Earned Income Tax Credit, which is a refundable credit, and then some of the other credits that you're going to see. So really, it's mostly that, and then of course we're going to go through at least one tax fact pattern and make entries in the software.
All right. I think that's all we got.
Okay, fantastic. Hey, thanks for all the questions. And Robert, I think that's important. If somebody has a question, I think we should do this next week or 2 weeks from now. Let's run through as many questions as possible. I think it helps me, and I think it helps the participants.
Sounds good. Once
Okay,
again,
thank you, everybody.
no session next week. We go again 2 weeks from today.
Right. And then we'll again go through at least one fact pattern, try to get to two. We want to get as much practice as we can utilizing the software.
All right. Sounds good. Thank you, everyone.
Okay, take care, everybody.
Thank you everyone for coming. Thank you, Jerry and Robert. Great job today.